Welcome to this week's version of Nichols and Dimes, our weekly video series. The bond market, it's been going a little wacky lately, and one of the main reasons is because interest rates are going up, and there's a real chance you, at least if you're in retirement or conservative, you have likely owned bonds for many years and still own them. So the question I have for you today is, should you still own bonds? Now, in 2021, the bond market had a rough year, and rough just from a purchasing power standpoint. Obviously, rates have been going uh, nothing but down over the last 40 years. And you may recall, interest rates and bond values have an inverse relationship. So when interest rates go up, bond values tend to go down, and when interest rates go down, bond values tend to go up. So, why am I bringing this up today? Because I think it's something we should consider. In other words, I think the traditional asset allocation model, where you have a traditional, say, stock, bond, and maybe a little alternative investments, may not work like it used to. And the main reason is because of inflation. Now, I'm going to get into some inflation data in a minute, but I wanted to share with you some interesting information I think would be valuable because at the end of the day, it's really not about what you make, as they say, it's about what you keep. So, again, why do people traditionally own bonds? Well, of course, bonds offer some diversification, they provide a predictable income stream. If bonds are held to maturity, again, to the extent the credit worthiness of the issue is strong, bondholders will get their money back, effectively their entire principal. So bonds are a way to preserve capital while investing. Bonds can also offer an opportunity to offset exposure to volatility, like stocks, for example, and then they typically offer higher interest rates than CDs or savings accounts. Ray Dalio, he's one of the most successful investors of recent generations, a billionaire. And he says investors make the mistake of judging their wealth in the number of dollars or pounds or whatever currency they're looking at. They should judge it in relationship to buying power. They can make serious mistakes if not, particularly in judging the riskiness of cash. And he also goes on to say if you buy a bond, you're locking in a negative real return. Cash is worse than that. Please don't look at your nominal returns and think that it's safe when it's not safe. Federal stimulus has boosted people's wealth on paper, but has also resulted in inflation, which erodes the real value of currencies. Now, we all know that if inflation's been in the news lately, and the government recently reported, well, let me take a step back. I'll get that in a minute. Historically, what is inflation? Inflation has been defined, at least by the Consumer Price Index, CPI, that has historically been around 2 to 3%. And of course, if you're earning a reasonable rate of return, say 5, 6, 7, or even larger than that, and your cost, if you will, that's the inflation rate, is say 2, then you have a net positive real rate of return. But we're in a different environment now where, at least in the most recent past, inflation has been larger, for example, than 2 to 3%. In fact, the Fed recently, at the end of 2021, said the consumer price index, if you will, is around 7%. So let's just do some simple math. Now, of course, what that means is just look at some bond issuances. The 10-year Treasuries yield is hovering around 1.7%. Corporate bonds a little higher. If you're even going to take some significantly increased risk, you look at junk bonds or high yield bonds. They're paying a little higher at 4.3%, and munis, which are tax-free interest, at least at the federal level, are paying about 1%. So again, doing some simple math, if you're factoring in inflation, again, the recent consumer price index, at least the Fed says it's around 7%. So you're getting your yield, and depending on what type of bond you're invested in, and after inflation, what is your real net yield? It's likely in the negative. Again, depending on what level of inflation you factor, and of course, what your bond is paying. This is a problem for most consumers. Now, let me take a step back. Historically, bonds have been fine to invest in. Why? Because it presupposes that inflation has been, say, 2%. So if you're getting a 4 to 5%, or even a 3 to 4 to 5% yield in bonds and your cost of goods is only 2%, your net yield is 1, 2, 3%. That's not bad. Again, with the other benefits of bonds being, a reduction in risk for overall portfolio. So not bad. But again, that's over the last 40 years. But the question is, should you have the same portfolio, at least because should you have money invested in bonds over the next 5, 10, 20 years? Well, my simple answer is, well, I would reconsider the strategy and maybe even consider answering the question, no. Why? Because to the extent, in our opinion, inflation is here to stay, or at least over a long period of time. And that inflation could be 6, 7, and even 10%, depending on what we're talking about. So if inflation, say 6, 7, 8, 10% on over a sustainable period of time, and your yield is 2, 3, 4%, going back to the chart I showed earlier, you're actually losing money in terms of purchasing power. So our message is the old model of investing, where bonds is part of a portfolio. I think we need to, or you need to, consider rechanging that thinking. Again, primarily because your purchasing power will likely get eroded, and it's almost fair to say that you're almost guaranteed to lose money in terms of purchasing power. Now, the Fed last year said that inflation is transitory, i.e., temporary, and they recently changed their language to effectively eliminate that word. It looks like they're acknowledging that it's likely, at least not temporary. There's a reasonable chance it's here to stay for some period of time. So again, we encourage folks to look at alternative investments to hedge against inflation. So again, what's the solution? Well, everyone has their own risk tolerance and time horizon. So these are some generic things you can consider. Consider things like private debt. Maybe you even consider private equity. By the way, there's some positives and negatives to these other asset classes. So I'm not suggesting you got to talk to your advisor or, in our opinion, an independent advisor to get the real story. But there's also real estate. Real estate traditionally has been a very good long-term hedge against inflation. Again, to the extent we have sustainable inflation, we think there's alternatives that you may consider. Again, the traditional model, in our opinion, where you just stick some money in bonds, and that's just sort of a set and forget it. We think those days are over. Consider alternative investments, again, to hedge against inflation, to give you what we think is a reasonable opportunity to mitigate risk over a long period of time, so that you can offset inflation and then your portfolio can grow. To that end, if you would like a second opinion on your bond portfolio or your overall allocation, and also to potentially look into some alternatives as we talked about today, you could send me an email at cnichols@nicholswealth.com or go on our website at nicholswealth.com to learn more about what we do. Thank you again for watching. Again, the old model of investing, we're not really sure. In fact, we're quite confident it's not going to work going forward. Again, to the extent we have sustainable, cost of goods or sustainable inflation. Thanks again for watching. Bye-bye.